So let's chat. One of the biggest issues that I hear right now, especially when we're talking with home buyers, and I know there's not a lot of them because the inventory is so small, but one of the challenges, and people are doing this and making a big, big mistake. Historically, you've been able to go and say, okay, well, I bought a house. I'm going to sit on my hands. I'm going to let the lender deal with getting the loan done. I'm going to let the title insurance deal with the title. Escrow is going to deal with the escrow. I'll be there for the home inspection. The appraisal will show up when they show up. I don't have to worry about that. And at the 11th hour, I'm going to call and see about getting insurance for this property right as we want to close. Yeah, it might cause a bit of a problem right now. So let's chat about that firsthand. Cory Neubauer is with us. Next Tier Insurance Services. Good morning.
Good morning.
So can you call real and get an insurance policy in the last 30 seconds of a transaction?
So yes, you definitely used to be able to do that. So, but just like interest rates are going up, prices are going up, everything on the insurance side is changing. So the carriers aren't as willing to insure a lot of these properties. So leaving this to the bitter end is not a good approach. We've been working with some real estate agents to actually, before they put an offer in, they have multiple properties, get a quote on those properties to find out what the cost of that insurance is, because it could be substantially different. If you're looking at two properties in the same area, one might be 10, 20, 100% more. So now insurance is now factoring into your decision of, what property you're going to go after.
Or it should. A lot of people don't even know this, and they're not finding out until the last minute.
Right.
And it is interesting because they'll call and they'll want to talk to us about interest rates. On a loan, and an eighth of a point on interest rates is going to scare somebody off, and it's $10 or $20 a month. And you're talking about significant changes in insurance costs.
Yeah, before you used to use maybe 0.5% or 1%, when you factor in
1/4%.
Or 1/4%. Yeah.
Yeah, so I used to put in 1/4% when we do a loan. Most of the time, between 1/4 and 1/3% would be a good number.
Right. So now that standard calculation is not there. I mean, we've had some where, previously it was, for a single family home, it was $3,000 a year for insurance.
Right.
And now it's 5x. It's 15, 20,000.
15 or 20,000.
Yeah. So again, it all depends on, the location of the property with fire risk now. And then also too, the claims are factoring in. Personally, for me, when I purchased a house, there were previous claims on the property, and I was actually hindered by the previous claims on the house for my future insurance on the property.
Well, think about that. 20,000 is about about $1,700 a month.
Yeah.
So it can be almost 50% of what your mortgage is, 25% of what your mortgage is.
So it's definitely something that you want to have a conversation before about to factor in that when you're looking at that cost sheet of what the true cost of the property is going to be.
Wow, I had no idea it was that much.
Yeah. So we're happy to provide a quote for that if you need. So any of your listeners or yourself, if you guys have things that you need a quote on, all we need is an address and a closing date.
So let me ask you this, Cory, because I'd heard something new that was new to me, probably not new to you, but that the underwriters actually want property inspections.
Yeah. So what's happening before, they used to trust a lot of the information that we were given or that they were given, right? The attributes of the property, has the roof been improved? There's different attributes of that, but everything's becoming more expensive, right? Labor is going up, inflation's gone through the roof, reconstruction costs, everything is going up. So these insurance companies are being more particular. So these rules and regulations were always in place. They just didn't really enforce them. So now they want to make sure. It's happening in auto insurance as well. When stuff's getting renewed, it's like, no, what is your actual mileage? What are we insuring, and what is the current condition of that property?
I guess that's pretty fair, wanting to know what they're insuring.
It is, but
it's kind of a shocking experience.
Yeah. Before, that with costs being lower, you control things that are, if they're not affecting the cost, then you don't have to worry about them as much. But the frequency of claims, everything that's happening, those prices are going up. So now the carriers are being more particular about what they insure, and they want to make sure that it's actually, what they're paying for. So
now that seems like it's probably the biggest issue there, the frequency of the claims, because if they're not getting claims, they're just wanting to collect the premiums.
Yes. So claims have risen dramatically too, right? With construction costs going up, with everything going up, that typical claim that might have been a few $1,000s is going to 10, 20, $50,000. So these insurance companies, like you said, they like to collect, and everyone's running a business at the end of the day. So you need to collect more than you pay out.
Yeah, insurance companies aren't in the business of just giving away money.
Correct.
That's
right.
And the other part of it, something you said there, kind of struck a thought with me. Sometimes that's scary. Is, if I had a issue with my property and it was going to cost me $300, $400, $500 to fix, I'm not filing a claim.
Correct.
If it's $3,000, $4,000, $5,000 to fix, as you said, with the costs going up,
yeah.
Well, now we're filing claims.
Correct.
So something that's not an issue that the events were not happening. The events haven't changed. They're still happening. It's just the cost of remedy has put people to the point of saying, so I'm going to file this one.
Yeah. And because of that, right, there's more frequency of claims. The insurance company's paying out more money, which in turn, right, you file a claim and in the future, your rate's going to go up. So it really is kind of now from a homeowner perspective, and we do a lot of stuff in HOA space, but it's the same thing for the homeowners, kind of managing that. Before, like, I have insurance, I just use it when I need it. Now, if I'm already paying $20,000 and I file a claim for a couple $1,000s, this is going to impact me for years ahead. So do you look at that and decide what the value of filing that claim is? We advise a lot of our clients also to raise the deductibles. A lot of people in the past said, I have a $500 deductible, I'm so insured. But the definition of insurance is a transfer of risk.
Right.
So if you're transferring,
most people say that again, because most people don't understand that part.
The definition of the transfer the definition of insurance is a transfer of risk. So you're
not the insurance company is not obligated to take this on.
Right. So you're paying the insurance company to take a certain portion of the risk. So let's use the example of a $500 deductible. If you have $1,000 loss, are you going to file a claim and only get $500? Probably not. So why insure that all the way down to $500? Maybe go up to a higher deductible. Now you're taking more of the risk, which means the insurance is taking less risk, which in turn should be less of a premium. So it's taking on more ownership or self-insuring for a larger portion to offset these crazy increasing costs. So we do HOAs. We've had some of our HOAs that have gone from a $5,000 or $10,000 deductible to a $100,000 deductible.
Wow.
Because the cost of that insurance from that $100,000 to that $90,000 span, it's a lot of money because you're insuring every single one of those units for an additional $90,000.
Which basically means they're going to have an assessment because they're going to have to add to their reserves.
Correct. Right. So we're going
to talk more about this when we come back. That is the Real-Time Real Estate segment brought to you by RSR Money. Continue our conversation. Cory Neubauer is with us. Next Tier Insurance Services is the name of the company. We're chatting about home insurance. A lot going into that. Now, Cory, one of the things this wasn't even on our agenda, but it just, wild things pop into my head sometimes. And again, those are kind of scary. So, you're mentioning in the last segment that insurance prices have been going up dramatically. Do insurance prices work like real estate or mortgage rates? Do they go up and down, or is it just a one-way street?
Well, it's kind of like gas prices, right? Do gas prices really go down? They might dip down a little bit, but the insurance company.
Depends who's president is.
Yes,
I shouldn't get into that.
At the end of the day, the insurance companies are collecting a premium in order to cover their liabilities and still make a profit, right?
Sure.
For admitted carriers in the state of California, they're also regulated by the Department of Insurance, so they have certain limitations of how much they can raise prices by. So I think it's somewhere in the neighborhood of 6.9% annually that you can raise without, scheduling a whole complete audit of of the corporation. So over the past few years, have things raised more than 6.9%?
Sure.
Right.
Lot.
So these admitted carriers like a State Farm, like Allstate, some of these other ones that are been in the news having challenges, not wanting to write new business in California, is because they can't raise their prices enough. So they can't cover their costs. So if they're not going to be able to cover their costs, what's their alternative? To stop writing.
Sure.
Right.
Not going to make it up in losses.
Right. So that's the biggest challenge right now. Everybody's, a typical homeowner is like, well, wait, why am I paying so much more, for the same type of coverage? But it's a simple economic. So if they can't make money, they're not going to offer, or they're going to offer it at a much higher price. Like we gave the example from $3,000 to $20,000.
So is that also why they're doing more inspections even on renewals?
Yeah. So what the insurance companies, it seems as though what they're doing is they're trying to protect themselves, right? So they want to make sure they have the cleanest book. Same thing with like a lender, right? Making sure that the person that's lending, the
Right.
credit score is right, everything. They're going to continue to check on that. So they need to clean up what risks they have on their books. So it's making sure that everything is the way that it's supposed to be.
So I'll go back, I hate to do this, 15, 20 years, give or take. And yes, I was a subprime lender. It was a great product to help a lot
Right.
of people. If it was used the right way. I mean, there was some people that were not doing it the right way, but it was a good product to help the right people.
Yeah.
New Jersey decided, well, we're not going to let the lenders charge for that risk. We're not going to allow you to, you have a borrower that's got a high risk borrower, you charge more interest. Similar to bonds, a government bond is going to be generally the lowest yielding. Junk bonds have a higher yield. So it's the same thing. Well, New Jersey said, well, we're not going to allow you to charge this kind of money in New Jersey.
So they stopped writing.
Yeah. So it's probably going to be the same thing that California will probably regulate insurance, and you get a battle between California saying you got to do all this, and Fannie Mae and Freddie Mac saying we have to be covered for this.
Yeah.
And then you have these two behemoths fighting, and we're the peons in the middle.
Yeah, it's the taxation portion of what you talked about at the beginning with California. Again, the more things are regulated, who's actually writing the insurance companies.
Right.
So if they can't make a profit, they're not going to write business. So we have we're staring at a little bit of a crisis here. And there's a lot of very smart people that are trying to figure things out. But in the meantime, it's a volatile insurance market, just like the housing market is very volatile.
Sure.
Right now.
So what'll end up happening in my forecast, and again, I'm not an insurance guy, is companies A, B, and C are going to leave the market. D, E, and F are going to raise their prices. Regulation will come in line at some point in time, and A, B, C will come back in with a lower price because now it's profitable, and that'll help with the other ones they'll have to do just for competition.
Correct.
It's capitalism.
Yep. I think the other thing too is that the ability to insure to such a low value, a $500 or $1,000 deductible, might be something of the past, where the individual is going to be responsible for more of those first dollars.
So I'll throw a consumer advocate pro tip for you.
Yeah.
So, and Cory's 100% correct, because we've done this before where we've had people that had challenges in qualifying. We'll ask them to go and increase their deductible for a short period of time or whatever. But even those that are in their home for a long time, take and start putting money into a Roth IRA if you qualify. You can talk to your tax people. And if you set aside, $100 a month or whatever into a Roth IRA, you can get to, over a relatively short period of time, enough money to offset that increased deductible. So that money's growing at a tax advantaged basis. No money, it doesn't cost you any money to take your principal out. The earnings, and again, talk to your tax people. But it just is a way of saving, a forced savings or a planned savings.
It is. We talk about just maximizing your insurance dollars. So now if you're going to have to pay 3 times as much and not get that much insurance, then why pay that, right? Back it off a little bit, do your strategy, right? Put some money aside so that you have for that rainy day. Because the typical homeowner, every 5 to 7 years, they have a claim.
Is that what it is, 5 to 7?
Somewhere around there. So, right. So you're averaging that if you're saving,
so it's 60 months, save $100 a month.
Or if you're saving $500 a month or
Right.
$500 a year,
Sure.
even, right? Over 5 years, right? You
Sure.
got your $2,500.
You got your $2,500 deductible right there.
Right. So that's the thing. So again, taking more responsibility for the property and knowing that and effectively managing it. You didn't have to do this before because that safety net was there.
Right.
But now that safety net costs so much money that you need to have a little different approach or strategy. So that's what we try to advise our clients of maximizing that spend of insurance.
So it's not just calling the insurance guy and getting insurance, right? It's the idea of having somebody who you can call who understands these strategies to help you make it work in a day and age like this. Continue our conversation. Cory Neubauer is with us, Next Tier Insurance Services, chatting about insurance. And we're learning there's a lot going on in the insurance world right now. And when we tie it in with real estate, insurance, I see on the chats all the time, people are very frustrated because there's no one educating them about what's going on in the insurance world and why this is happening. So that's what you're listening to Ron Siegel Radio for. That's what we do all the time. So, Cory, one of the comments, I think you made it early on today, that the number of claims that are against a property stay with that property.
Correct.
What's that? I forgot. There used to be a report. I forgot the name of it. You have to go to the insurance people to get it.
Yeah, like a lost history report.
Lost history report. Yeah, that's some acronym that was funny for it. But it basically tells you there's been 75 water claims on this property, and now no insurance company is going to ever touch it again.
Correct. Well, the insurance company, right? The attributes of that property carry on, right? If you had a water loss because a pipe burst or something, those attributes still exist within the property. So those, again, they're using more and more attributes to calculate the risk, and then charge.
Like baseball and analytics.
Yes.
Same concept, right?
Yeah. But the scary thing with some of that stuff is, right, your homeowner's insurance can actually cover personal property. Like say you have your golf clubs in your car and they get stolen. That goes against your homeowner's insurance.
Oh, okay.
So there's a lot of things, again, you need to be cognizant of, where before it didn't really matter if you filed a small claim. But it's becoming more and more important to manage your claims history, because it's going to come to haunt you, kind of like your credit score. It's so important now. A couple points can really change the rate dramatically.
So do I don't know if we want to go down this rabbit hole. Because with what you just said, it makes you say, okay, well then an insurance company should have the ability of pricing based on zip codes.
So they go by zip codes, but they're even going further to go by some economic information about particular owners of the property. In the HOA space, they're looking at the demographic of who is purchasing and occupying these properties. So it's going. I mean, the actuaries are going further and further to get as much data as they can to create, a risk profile.
Wow.
Yeah.
So that's going to open up a whole nother can of worms when you're trying to get all of the demographic data.
It's more personal information. What I didn't FICA just do that with? If you want to open up more of your credit, your checking account information.
We're not allowed to use it, so it's there. But
my point, right? Like it's using more data, right? Everything's now becoming data driven.
Absolutely. Well, the irony is it's against the law for a lender to discriminate against anybody for anything.
Yeah.
Yet, I did do a loan for somebody that was 93 years old taking out a 30-year mortgage.
Right.
The likelihood is of him paying that off, his estate will, but he's not going, right?
Yeah.
But they also, what is your sex and what is our, black, white, Hispanic, Asian. You have to ask those by law.
Yeah.
But you can't use them.
Right.
I wonder why they want to know this.
Yeah.
Right. Somebody's using it for some reason.
It is. I mean, at the end of the day, right, all this plays into, it's going to be a higher price.
Sure.
At the end of the day, they're trying to get more information so they can justify, what that price should be.
So are you seeing more? So you mentioned this before, and I think I did this before as well. $500 to $1,000 was usually a pretty common deductible.
Yeah.
Where are you seeing them at now?
For an individual homeowner, right, if you've had prior claims on the property, like myself as an example, right, there was a couple water losses on the property when we bought it. We wanted to get $1,000 deductible. They wouldn't offer it. We had to go to $5,000.
Wow. Okay.
So $5,000 deductible is, again, if you use a strategy that you're talking about, again, that's going to save you a lot of money, because the insurance company's not going to get involved until something over $5,000 happens. So you kind of, you self-insure, you manage that on your own.
So it's kind of like if you're going and you can afford it, getting a major medical policy as opposed to getting, something that covers you for broken fingernails.
The car example is the easiest. If you get bumped in the bumper, right, you guys figure it out between yourselves, right? You don't necessarily file an insurance claim that's going to affect you for years afterwards. If it's a smaller dollar amount, you take care of it. So the household is going to need to be looked at that same way.
Now, I don't know how it works on the car, but does insurance follow the individual, or as far as home insurance? Is that following the individual, or is it following the property?
It's following the property, as we talked about before, right? If there's a prior claim on the property, especially if it's water loss, right? Because then there's something potential systemic issue. I live in South Orange County. There's a lot of water problems, right? The pipes, there's pinhole leaks. water claims are the number one claim of all insurance.
Really?
So, and from home insurance. So,
Sure.
and it's so destructive, right? Because water goes everywhere. So,
And you think about a pinhole, and you don't realize how much water comes out of a pinhole.
a week later, stuff coming out the front. So, there's a number of things. I mean, even the insurance companies for those, I think they're having automatic shutoff valves, water shutoff valves. That
interesting.
For a renewal, you're required to put this on, or you won't be renewed.
Really?
So in some areas, especially if they've had a lot of claims. So we do that. A lot of the insurance companies offer discounts in order to put that shutoff valve, but it monitors the flow of the water and it knows the profile. And if a bunch of water starts going, it'll shut it off. So
that's a good thing.
It's a great thing, right?
Because with technology, you would think that we could get a lot of this monitored better.
Making the house smart, right?
Right.
And, I mean, I have an application that it alerts me when it sees or experiencing something odd, and it'll shut it off if you don't respond. So.
Now, I know you're not the contractor for Ron Cigar Radio, but is these automatic water shutoffs, are they expensive?
No, $300 to $600 plus some installation. Cheap. Under $1,000 for sure.
That's really cheap.
But that might give you some ammo to go back to the insurance company and saying, this is what I'm doing. The insurance companies want to know that you're effectively or actively managing the property, right? Are you repairing the roof, right? Are you keeping it in good maintenance? Do you have preventive maintenance in place? So a lot of the larger insurance companies offer discounts for that. So it's a good way. Before you didn't have to worry about it, but now you need to look at every approach to try to, what we say, mitigate cost increases, because they're going to go up.
Sure.
But are they only going to go up 10%, or are they going to go up 50 or 100%? So,
and then the idea is where you can go back and work hand in hand with your agent.
Yeah.
On, you're the first person I've ever heard say. I mean, I had somebody else tell me that they had a company that went by and monitored for water issues, so you wouldn't have that week-long issue.
Right.
But where you have a auto shut off or an app that tells you that.
Yeah.
We've got a Ring app that tells us if somebody's at the front door.
Yeah.
And I control my air conditioner from my phone. I turn it on before I leave the office.
Yeah, they have. I mean, just even though the water heater scenario, right? People are going to a tankless water heater, which gets rid of that having hundreds of, or 50, 60 gallons of water in your, just sitting in your garage. Or there's shut off sensors that are at the bottom of a water heater to shut off the water, because it is right. That water just keeps flowing.
Is there any kind of a list of these different items that can be that we can address?
Yeah, the California, there's quite a few. I can give you guys some referrals, but yeah, there's definitely a number of the cities do it, so you can check your local city for energy efficient as well as safety. I mean, they're offering irrigation classes, right? How to reduce water usage. So it kind of falls hand in hand with energy.
Okay, it's all in that same. It's in the same boat.
In the energy savings and water savings, and safety, just like a kind of like a low flow toilet that you would buy.
Okay, so I didn't know that those all tied together. So it's So now we know where to go to look for them.
Yeah, correct.
Yeah, that's so because maybe you guys are smarter than me. I most probably are, but the issue is until somebody tells you about some of these things, you just have no idea to even go out and look.
Yeah. Well, I think too, in the past, right, stuff was going up 3 to 5%, right? Just like your mortgage. If you can't save a lot of money on your mortgage, you're not going to shop.
Right.
But once prices go way up, or you have the option to save a lot of money, you want to shop. And people shopping right now for insurance are finding a completely different market.
How long does it take on a new purchase, a new policy? Because it used to be, like I say, as a service, our team always would go and get a quote just to throw in the file.
Yeah. So in the past, you could do that pretty quickly.
Right.
But again, now with the carriers having more and more challenges, they're putting more roadblocks in place. Some of them have a 14-day waiting period, a 21-day waiting period.
Oh, wow.
So you can't bind the policy for that number of days. So every carrier is a little bit different. And again, the carrier is trying to manage their risk. So you'll have situations where if you come a week before, it's like, hey, I'll see you in 3 weeks. That's when we can bind the policy. So getting ahead of this is now even more important. And to anyone that is currently insured, right, we say if you get a renewal, take it.
Interesting, yeah.
Because those prices, the underwriting guidelines are getting more precise, right? They're getting more particular. So you're going to be exposed to a higher list of things that you need to do in order to get insured. So there's still a number of carriers that are writing, but it's not as easy to just go, oh, well, let me go on the internet and find 5 insurance quotes and we'll pick the cheapest one. And they're also changing a lot of their parameters. One carrier used to have what they called guaranteed replacement. So you would, no matter how much it cost, they would pay to replace, the affected, from the affected peril. Now they're putting a cap on it. So if you have limits to 300,000, that's where they're stopping. So again, they're trying to limit their exposure on a lot of things, and the consumer needs to be aware of that and take it under advisement. So
shame this stuff isn't publicized more. I mean, I don't hear it in the news anywhere. I've heard some of this, through colleagues, and through some of the chat groups on social media.
But it's super dynamic. It's happening kind of on a daily basis now, and things are sliding, further and further away from a normal market. So we're definitely in a hard market. And again, everything is being done to try to backstop so that they remain profitable.
So remain profitable and know what their exposure is.
Yeah. One other thing that we saw was some of the carriers are now offering 2 months. So when you renew your policy, you got to pay 2 months and then amortize the rest of the term out. Other situations that we've seen is in the past, if you missed a payment, now going forward, you have to pay in full.
Oh, wow.
So there's a lot of things, kind of like if you bounce a check at a grocery store, your check's no good here anymore. It's that scenario. So it's all a thing of trying to buckle down on some of the inconsistencies of some of the insureds.
It's going to be fascinating to see how this works with the impounded insurance payments.
Right.
Where you've got the servicers actually making those payments. So are the insurance companies giving enough time so it gets through the entire system to get back to the borrower, the homeowner, to make that whole full circle again?
Yeah, it's something, right, again, that you'll potentially want to take over and manage, right? It's kind of like if you're having your property taxes impounded.
Right.
You could do that for convenience, but then you're also relying on someone, a third party to do that.
Sure.
So
great information. If you want to get more information, if you want to get an insurance and quote, if you want to get serviced, get more of these ideas from Cory, give us a call at 800-306-1990. Be happy to put you in touch with him.